Paris, February 4, 1965. A tall French general strides to the podium at the Palais de l'Élysée. 200 reporters lean forward. De Gaulle has called an unscheduled press conference. No one knows the topic. He clears his throat and declares that gold, not the American dollar, is the only true measure of wealth. He calls the dollar system a form of credit monopolized by a single nation, and he announces that France will begin converting its dollar reserves into physical gold immediately. Time magazine calls it the most open assault on the monetary power of a friendly nation ever, launched by a head of state. Within 2 years, France will drain thousands of tons of gold from American vaults. Within 6 years, the entire Bretton Woods system will collapse. The dollar will lose its gold backing forever. Now picture this. Beijing. 2022. China has just watched the West freeze $300 billion in Russian reserves with a keystroke. No trial, no warning. Frozen. The People's Bank of China begins buying gold every single month for 18 months straight. It cuts US Treasury holdings by nearly half, from $1.3 trillion to under $700 billion. They are not converting dollars to yuan. They are converting dollars to gold. Same pattern, same logic, same outcome. Here's what should get your attention. The dollar's share of global reserves has dropped from 70% to 58% in 20 years. Central banks bought over 3,000 tons of gold in just 3 years, 2020 to through 2024. And not a single central bank surveyed by the World Gold Council plans to reduce its gold holdings. Not one. By the end of this video, you will know exactly which 5 episodes triggered central banks to dump dollars for gold, what happened to the gold price every single time, and why the pattern forming right now is the most aggressive in modern history. I'm the Fiscal Historian. This is history, not financial advice. Do your own research. Now let's get into it. The 4-stage pattern. Eve studied 5 separate episodes across 6 decades. Each one follows the same 4 stages, derived from the evidence and the evidence alone. Stage 1. A country recognizes that its dollar reserves are a political liability, not just a financial asset. Stage 2. It begins converting, quietly. Stage 3. The conversion becomes public. Stage 4. The gold price reprices to reflect a world with fewer dollars and more gold. France in 65. The London gold pool in 68. Emerging markets after 2008, China and Russia after 2014. The entire developing world after 2022. Same stages, same sequence, every single time. Episode 1. De Gaulle's gold offensive year is what most people don't know. France didn't simply ask for its gold back. France launched a covert, military-style operation to retrieve it. The operation was called Vide Goussettes, French for empty pockets. It began in September 1963 under the direction of Jacques Rueff, de Gaulle's economic advisor. Rueff was a former deputy governor of the Bank of France, dismissed under Vichy's anti-Semitic laws in 1941, who spent the rest of his career arguing that the dollar system allowed America to run deficits without consequences. Over 3 years, France moved 3,313 tons of gold from New York and London back to Paris, 44 boat trips, 129 flights. Ocean liners from Compagnie Générale Transatlantique carried 25 tons per voyage. De Gaulle wanted to send the missile cruiser Colbert to New York to collect it. His finance minister, Valéry Giscard d'Estaing, the man who coined the phrase exorbitant privilege, talked him out of it. Too conspicuous. By 1967, gold made up 92% of French reserves, up from 71%. France then withdrew from the London gold pool entirely on June 11, 1967, forcing the United States to shoulder an ever larger share of the defense. What happened next? Gold went from $35 to $850 by January 1980, a 2,300% gain. France's gold, retrieved at $35 an ounce, is worth over $360 billion today. Episode 2. The London gold pool collapses. Second episode proves this was not a fluke. 8 central banks formed the London gold pool in November 1961. The United States contributed 50%. West Germany, the United Kingdom, France, Italy, Belgium, the Netherlands, and Switzerland split the rest. Their mandate was simple: sell gold whenever the price rose above $35. Keep Bretton Woods alive. It worked for 7 years. Then it didn't. On November 18, 1967, Britain devalued sterling by 14%. Gold buyers panicked. In the final crisis, The first 2 weeks of March 1968, the pool hemorrhaged nearly 1,000 tons. On March 8 alone, 100 tons were sold. Normal daily volume was 5. On Thursday evening, March 14, Treasury Secretary Henry Fowler and Fed Chairman William McChesney Martin called London and asked the British government to close the gold market. On Friday, Queen Elizabeth proclaimed a bank holiday. The market stayed shut for 2 weeks. When it reopened on April 1st, the price was $38. The two-tier system that replaced it lasted 3 years. Then Nixon closed the gold window entirely. August 15, 1971, American gold reserves fell from 20,000 tons in 1957 to under 11,000 by 1968. A 46% decline. The people who bought gold at $35 and held until 1980 saw a 24 times return. The people who held dollars lost 2/3 of their purchasing power to inflation by 1980. Episode 3. The post-2008 pivot in 2009. Central banks shifted from net sellers to net buyers of gold for the first time in decades. The catalyst was the financial crisis. The mechanism was fear. India moved first. In October 2009, the Reserve Bank of India bought 200 tons from the IMF at $1,045 an ounce, the largest single increase in India's gold holdings on record. Then China disclosed a surprise. In April 2009, Beijing revealed it had secretly accumulated 454 tons since 2003, a 76% increase. Nobody knew. Russia began buying steadily from around 400 tons in 2008. Over the following decade, it added more than 1,600 tons. First Deputy Chairman Sergei Shvetsov told a conference in 2017 that he would not dwell on the geopolitical environment, but that everyone understood the role of gold in ensuring a country's financial and economic security. Gold went from under $700 in late 2008 to over $1,900 by August 2011. The central banks that bought early multiplied their holdings in value. The ones that waited paid more. Episode 4. The China-Russia acceleration. After Russia annexed Crimea in 2014, something changed. The buying was no longer occasional. It became strategic. China's official reserves climbed from 1,054 tons in 2009 to 2,236 tons by late 2025. China added gold for 18 consecutive months starting November 2022, and during that same period, China slashed its US Treasury holdings by nearly half, from $1.3 trillion to under $700 billion. That is not diversification. That is substitution. Russia's reserves grew from 600 tons to over 2,300, but the real turning point came on February 24, 2022, the day Russia invaded Ukraine. The West froze roughly $300 billion in Russian foreign exchange reserves. That single act changed the calculus for every central bank in the world. If your reserves can be frozen by a foreign government, they are not reserves. They are hostages. Gold cannot be frozen. Gold cannot be sanctioned. Gold sitting in your own vault belongs to you and nobody else. Every central bank on earth watched what happened to Russia's dollars. And every central bank that held dollars asked itself the same question: could that happen to us? The answer was yes. The response was gold. Episode 5. The 2022 to 2026 surge. Numbers tell the story. Central banks bought 1,082 tons in 2022, the highest since 1950, 1,037 in 2023, 1,045 in 2024, 863 in 2025, over 3,000 tons in 3 years, roughly double the pace of the previous 3-year period. Poland led the buying in 2025 with 102 tons. Kazakhstan added 57, Brazil 43. These are not marginal players experimenting. These are sovereign nations making structural decisions about where to store national wealth. The World Gold Council's 2025 survey found that 95% of central banks expected global gold reserves to increase over the next 12 months. 0 respondents planned reductions. 75% said they would reduce exposure to dollar-denominated assets. And here is the number that should stop you cold. By August 2025, the total value of central bank gold holdings, $4.5 trillion, overtook total foreign holdings of U.S. Treasuries, $3.5 trillion, for the first time since 1996. The dollar is not collapsing, but it is being replaced, slowly, methodically, ton by ton. And the people doing the replacing are the ones who print the money. What goes to zero, the asset that loses in every one of these episodes, is not the dollar itself. It is unhedged dollar exposure. The dollar remains the world's primary currency. But the assumption that dollar reserves are safe, permanent, and untouchable, that assumption died in February 2022, and it is not coming back. Savings accounts denominated in dollars. Government bonds paying interest below inflation. Cash sitting in a bank earning 3% while groceries rise 5%. These are the positions that get quietly consumed. Not in a crash, in a slow, invisible transfer of wealth from people who hold paper to people who hold things. Where we are right now as I record this, gold is trading above $4,700 an ounce. 13 months ago it was $3,000. It has nearly doubled since the start of 2024. The United States has imposed a naval blockade on the Strait of Hormuz following the collapse of peace talks with Iran. Oil is near $100. The U.S. deficit is running at $1.2 trillion in the first 6 months alone. The national debt crossed $39 trillion in March. Interest payments are running at $88 billion a month, more than the government spends on defense and education combined. The Federal Reserve is trapped. Cut rates and inflation accelerates. Raise rates and the government cannot service its own debt. There is no painless exit. The central banks see this. That is why they are buying gold, not because they read blogs or follow trends, but because they are the ones who print the money. And they know what happens when you print too much of it. The closing. Gaulle saw it in 1965. The gold pool collapsed in 1968. Emerging markets pivoted in 2009. China and Russia accelerated in 2014. And after 2022, every central bank in the world is moving in the same direction. 5 episodes, 5 decades, same pattern, same stages, same outcome. The question is not whether the pattern will continue. The question is whether you will position yourself on the same side as the institutions that control the money supply or on the opposite side. That is the historical record. What you do with it is up to you. I'm the fiscal historian. If this kind of deep pattern analysis is what you're looking for, subscribe, because this is what we do here. And I'll see you in the next one.